You're listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Hello, welcome back to another episode of The Builder's Mindset. Today, we're going to talk about margins. Since the earnings report summary has been out for a couple of weeks now, and if you haven't gotten your copy, click the link in the show notes below to get your copy, because it'll be easier to follow along if you have that with you. So obviously the public builders, that's what the earnings report is about, because they all, by SEC rules and guidance, have to submit certain reporting information. Their revenues public, their profits, their margins, they have requirements for what they have to share with the SEC and put out for their investors. And so that's what I provide to you. It's just a quick and dirty look at their number of closings, their net revenue, their gross margin, their pre-tax income, their net income percentage after taxes, their SG&A, their sales, general and administrative expenses as a percent of home building revenue, their average sales price of their homes, net sales for the period, the absorption. If I can find it and figure it out, they don't all report on that, but as you know, that's one of my favorite metrics, is how many homes they are selling per community per month. Their net cancellation rate, which most of them put out, but a few of them don't. Like to know that too, basically like how many orders net relative to how many orders came in, the cancellations, and so what is that as a percent, and number of employees, and the closings, another one of my favorite metrics, the number of closings per employee, and I annualize that. I don't report that from a quarterly perspective, so it is the quarterly data times by 4, just because it's how I put that together. And then cycle time, calendar days, which are also one of my favorite metrics that a lot of builders don't report on. They talk about it, they talk around it, but only a few of them actually go deep into that. So this week's episode, we're going to focus on margin. We'll talk about gross margin, and then the net income after taxes as a percent. And so interesting is, we'll start it off with it. What is a good margin? I mean, if you're one of the public builders, you kind of you stack yourself up against the rest of them. Wall Street cares about it. Wall Street a lot more cares really more about consistency and hitting the mark within reason, right? If you report much, you say, hey, next quarter I'm going to do 3 points less, 300 basis points less, which is 3%, less than last quarter. Even if you hit that, they're not going to be happy with that because they don't like that. But within reason, if your margins are consistent within a range and from a reporting perspective, and you hit that, usually that's what Wall Street wants to hear. But what is that? And if you have the copy of the report, where you'll see when you look at the gross margin reported by home builders, the numbers range anywhere for those publics between 18.9% and 28.8%. That's a pretty wide range, right? And we've got everything in between. Sorry, take that back. 32.7% was the largest. Green Brick Partners, a very profitable home building company, a little bit kind of down the list on the publics, but still a good sized builder, really, really well run company. I think I'm going to do a little bit of a deep dive into them, learn more about them, because their metrics are just phenomenal. So 18.9 to 32.7% on the gross margin. And then on the net income after tax, as a percentage, negative 6.1 all the way up to 17%. So when you ask yourself, what is a good margin? And last week we talked about, kind of the difference between publics and privates as it relates to their year end, and how they approach the numbers and hitting the numbers, right? private home builders don't have to report, so they don't really have any kind of like stock metrics. They may have investors, they may have public money invested in them, but still not actually publicly traded. So there may still be certain things that are driving from an outside perspective forces to push them to increase their margins and get their growth. And so, but it's interesting because a lot of people that I know in the industry that I've met over the years either love the public home building industry or there's a little bit of a disdain for it. As I mentioned in last week's episode, I've heard people refer to them as like, the big box builders, things like that, et cetera, et cetera. Which is interesting. People don't think of like Shea Homes. Shea is, one of the nation's largest builders, but they're a privately held builder. The New Home Company is one of the larger home builders in the United States, also technically a private home builder. And so, but there's a lot of talk about that. But because, as we said, like the data that we have at our fingertips, because we don't work for every single one of these private, the data we have at our fingertips is out of the public builders. And so as we look at that, it's kind of it's a window, it's a benchmark, it's an index. And so the question I have really for the listeners is, what do you think is a good gross margin? What do you think is a good net income, after tax? And so, a lot of people would look at those margins and say, this is, they're really good, they're great numbers. But like I would challenge you to say like there's a lot more that goes into that than other situations in terms of like if you look at Dream Finders Homes, for example, they had a 27.6% gross margin, which is really solid and really strong, but their net income percent after taxes was only 7%, not the lowest, but one of the lower ones on the market. But they're growing, right? So there's a lot of reinvestment in land. And so there's a lot of things that impact that net income after tax. And so it's things like, what are they reinvesting as far as their money into land? What is their SG&A expenses, their sales general administrative expenses? We look at that and we talk about that in greater detail. Some of those, the numbers range widely in the SG&A expense. And then as I talked about, like I like to look at closings per employee. Obviously, if you have more closings per employee, you're leveraging your systems, you're leveraging your processes, and you're able to get more done with fewer people. And so that at the end of the day helps that where that number is, that delta between, say, the gross margin and the net income. But it helps, in my opinion, to start with a solid fundamental gross margin. And so anybody can, say what is a good solid gross margin. I generally think that your solid gross margin, you should strive to be over 20% on your gross margin, and the higher that you can be in that area, the better you are. If you're lower than that, that can be tough. As you get larger, though, you might be lower than that, but the cash flow in terms of what you generate is a larger amount. But I think the question for all the private builders, the ones who don't have to report the data, is like, what is a good, start with this, like what is a good gross margin relative to like then your net income, right? Because as we said, there's a lot of things that go into the difference between the gross margin and getting to that net income after tax. And so I think you have to sort of look at, how that impacts things from the perspective of, at the end of the day, a company's job is to make money, right? Like even a private. And like I said, I talked about the funny thing about some people like have sort of this feeling about big builders and big public builders versus privates. But, at the end of the day, the job of a home building company is to build houses at a value proposition for their customers that makes a reasonable gross margin that allows them to reinvest enough in the company, land, et cetera, and whatnot, so they can continue to sustain or grow their operations and do so in a way that also then at the end of everything and all the expenses, there's a decent amount of net income that's left there. I don't think a lot of people realize that, when a home builder builds a home and sells it and they move and they go on to another home, another phase, or another community, they're not done. It's very dependent by the state, but there's a warranty that has to be maintained, and that there's certain expectations based on each state has its own rules from a structural aspect, from a fit and finish aspect. I have friends who've owned home building companies and sold them, and they're still, because their name was on the contractor's license, they're still holding that warranty. And that warranty has to be, taken care of. So if something happens and within the guidelines and rules and regulations of the state, it's something that they're supposed to fix, they have to come out of pocket to fix that if it's a warranty, because there are certain things, and I know you say, well, the warranty should go to the manufacturer, but not all warranty claims are based on manufacturer. Not all of them are very clear and able to, be charged back to, say, a trade partner. So you have to save some money, and you have to be making enough money, in my opinion, to make it worthwhile to carry that warranty and liability, and then also to sustain your business. So I don't think there's a right or wrong answer per se in terms of what is a good gross margin and what is a good net income after tax. I think there's some guidelines. As I said, I firmly believe your gross margin should be north of 20%. And I also feel like your net income after tax should at least be positive. And I feel that it should be above 5%, and arguably upwards of 10%. Building houses is a noble profession, but it's not easy. It's a difficult amount of work. There's a fair amount of liability that goes to whoever holds the license. And so those are some guidelines. So, with that, I would say I'm curious to what the listeners think. What do you think is a good gross margin? What do you think is a good net margin? I'd like to hear from you guys in terms of what a home builder should make. Then we can dive into how do we get there? How do you get to that place? That's the other thing that's tricky in terms of we can have goals for our target margins. Sometimes we meet them, sometimes we exceed them. And sometimes we don't. And there's a variety of reasons sometimes why we don't. And so when we look at a snapshot of the current margins for home builders, the public home builders, it's a snapshot in time. This is for the last 3 months. And so there have been times when home builders margins are not as good, not as strong as they are. There were times when they were stronger than they currently are. And so I think it's a balance. And most home builders look at I think they run their business looking at it from a 3 to 5 year perspective. And they're always kind of looking at that 3 to 5 year window. And so in looking at that 3 to 5 year window, what do you think is a good gross margin for a home builder to make? What do you think is a good net income after tax margin that a builder should make? It's an interesting topic. It's an interesting discussion. As I said, it's not cut and dry. It's not black or white. But as I said, my belief is that home builders should be north of 20% on a gross margin, north of 5% on a net after tax. And I think a lot of builders aren't. That's another question I have for you if you're a private builder. Is your company north of 20% gross margin? And are you north of 5% net after tax margin? I know there's a lot of builders out there that aren't. And as we said, there's a variety of ways to do that. Sometimes builders hit their margins, sometimes they beat them, and sometimes they miss them. You look at a piece of land, piece of dirt, and you say, I'm going to buy that piece of dirt. You put a product on it. You plan for a certain product on it. You do market research. You develop that product, or you pull it off the shelf if you're a builder who has library type product, and you plan to go to market. Is it finished lots? Not a lot of those left, so you're probably developing that land. That takes time, and that's cost. There's potential for cost overruns on land development. There's potential for time overruns on land development. And this market, we talked about it. This market is seasonal, or this business is seasonal and cyclical. And so what I mean by that is we have ups and downs within a year, and then we also cyclically have times when the market's stronger and the market's not so strong. Case in point, as I want you to take this thought away as you think about what is a good margin. Right now, the home building industry has arguably been in a positive upswing of the cycle for around the last 10 years. Typically, we see 10-year cycles where there's 7 or 8 good and 2 okay years. This has been a new type of cycle in that we've had basically 10 pretty good years. Yes, have we had some blips in there when interest rates went up? We've had a quarter or 2 quarters where it's looked like it's kind of not so great, but we've not had a solid year or 2 strung together consistently where it hasn't been great from a demand and a margin perspective. But it is getting more and more challenging right now, and so let's say we have a cycle time where things soften up for a couple of years. We've had plenty of them. There's in the 80s and the 90s and the early 2000s. We've had these. Go back to that. You buy this piece of land. If that land comes to market in one of those softer times, you might not be able to sell the homes for the price that you thought you could sell. Now, when you get ready to go to market, you've put the cost into the land, so that's already fixed and done and set. You probably almost got done with your land development, and so that's fixed. The only thing that's typically left when you get ready to go to market is your direct cost, your vertical cost, the cost to construct that home. Now, we hope that those costs follow the market, meaning if sales price is down, we hope that direct vertical costs are also down. But there's a lot of timing in that. And so maybe they're not down quite as much. Maybe they are, but then at the end of the day, still because of those fixed land costs that you have in there as fixed development costs, you might still be in a position where what you thought was going to be a 23% gross margin community is now actually an 18. And so, and that could end up going, taking you from a 7% net income to a 3% net income. And so, and any other little blip in the system could make that go closer to 0. So, once again, what is a good gross margin? What's a good net margin? I'm curious, or net income. What do you think? And, there's lots of factors that go into that. And I would say, though, is if you're not at 20% on average overall, not community by community, you're going to hopefully you have a variety of communities. You might have some above, some below, just because of different reasons. But if you're not, I suggest that you start thinking about why you're not. Lift the hood, look under the hood, and start to figure out, there's some standardized metrics that you can look at in terms of your percent of revenue, what your finished lot cost should be, what your vertical and direct cost should be. These are things that I look at all the time with clients and help us try to figure out where some things are off so we know what to go and attack. But if you're not above 20% gross margin, I challenge you to look under your hood and try to figure out why, so you know what you can go after and where's your lowest hanging fruit. So with that, like I said, if you haven't gotten the report, go grab it. Some great information. I think it's really good to track the big, large builders to see what they're doing. It's a good benchmark. It'll help you tell you how the market's moving from their perspective, and how they're performing today in the last quarter relative to all of the challenges they have. So with that, let me know what you think. What's a good gross margin? What's a good net income after tax? Look forward to hearing and seeing your comments below. Thanks again for listening. We appreciate you. I hope you have an amazing day. Thanks for listening to The Builder's Mindset with Mike DiGiovanni, presented by Amazing Mindsets. Remember, your mindset matters,